Hello, everyone. Welcome to another episode of Smokin Bulls. I'm Tyler.
I'm Dave.
And today we're joined by Lori Hartery. She's a returning guest here to Smokin Bulls. You may not have seen her last time because we didn't get our cameras rolling, so it was just an audio podcast, but hopefully you checked that one out. Today she's joining us again, so thank you very much for joining us, Lori. She's here to chat with us about estate needs. So some of the issues that you might run into in terms of taxation and the costs that might be involved in closing up an estate. So Lori, she is the regional sales director for Desjardins Insurance here in Alberta. And I'm going to turn it over to Lori, and she can do a bit of an introduction for herself, and we can jump into today's conversation. So, Lori, again, thank you for being here, for a second-time guest here on Smokin Bulls. We always appreciate having you on.
Tyler. Thank you, Dave. Thanks for inviting me to join you today. As Tyler mentioned, my name is Lori Hartery. I am the Regional Sales Director for Desjardins Insurance for the Prairie region, Alberta, Saskatchewan, and Manitoba. I've been with Desjardins for about 8 years now, but in the industry, more than 2 decades or so, working with advisors, working with clients, looking for opportunities on how we can help clients maximize their estate, particularly working with couples who are building their assets today, sacrificing, saving hard to build assets for the future. It can come as a bit of a shock, a surprise, the expenses, the taxes that may be due later on when they want to distribute those assets to their heirs or to their favorite charity. And so I know that's going to be our topic today. It's a really good topic to be having with clients. So thank you for inviting me.
Yeah, you bet. And I think a great way to get started on this, Lori, and I think you have some slides to share with us today, but a lot of people don't really know what their final estate tax bill might look like. And so I think a great way, and I think you're probably ready for this, but a way to describe to people what they're going to owe in at death would be to work through a bit of like a calculator. I think Desjardins has some tools that we've used. I know we've used them for some of our clients to help determine what taxation might look like at death. So maybe we can kind of work through something like that. Does that sound like a reasonable way to move forward?
Absolutely. Absolutely. And so the calculators, as Tyler just mentioned, a lot of clients, once you work with your financial planner, once you work with Tower Wealth to put in those assets, those things that you are building today that are growing, right, in value over time, a lot of clients are going to be shocked as to what the estate expenses are going to be before they distribute their estate. And so Desjardins does offer an estate needs calculator. It's a simplified calculator to help understand what those expenses are going to be. Your advisor, Tower Wealth, would walk you through this, but I will share my screen. I find giving clients an idea of what it looks like. How did you arrive at that information? My plan is to briefly walk you through the calculator and then, of course, talk about some ideas, how Tower Wealth can help maximize your estate, covering off those estate expenses. So if you can bear with me one moment while I share my screen.
You bet.
So you should be seeing the estate needs calculator.
We are.
Excellent. Okay. So this is what it looks like. And this is what Tyler and Dave would run through with you, capturing all your various assets. They may already know your assets and able to put them in, but we just wanted to give you a snapshot. So I've got some sample clients here. We've got a couple, John and Mary. John is age 50, Mary age 49. Both live in Alberta. When taking a look at your assets and the growth over time towards life expectancy to maximize what they're going to leave behind, to maximize their estate, we're going to look towards life expectancy ages. Now, in this particular example, I used a life expectancy of age 86. And so I put age 86. And so we're going to look about 36 years out. What is the value of those assets and what are the expenses that the estate is going to have to pay in order to distribute those assets. It pulls in marginal tax rates. It also pulls in the estate costs. The estate costs, these are things people, generally clients, are not thinking of today. What is the estate administration fee going to be? Well, that could be as high as 5%, right? There are executor fees that can be taken from administering the estate. But there's also legal and accounting fees. Now, in my scenario, we use $7,000 and we're going to index that at a 2% inflation rate. These numbers can be changed depending on, every client's scenario. If they know what those numbers are, those can be inputted into the calculator. Then, of course, there's final expenses, right? Paying for that celebration of life. Everyone's idea of that celebration of life may be different, and the costs associated may be different. That number can be changed to match and mirror what are the client's expectations. I'll just leave it as $25,000, but as we know, inflation, right? Inflation will grow over time. I'll index the final expenses at 2%. Once we have the preliminary data into the system, what Tyler and Dave will do next is they'll come up to the Assets tab. This is where they're going to capture your assets to input into the calculator so we can determine what is the value of the estate going to be at life expectancy at age 86. So different assets have different rates of return, different taxation, so on and so forth. So let's go ahead and start entering for a typical estate. So first and foremost, principal residence, right? The client's home. So we'll add that in. Now, in my example, John and Mary each own their home. So we'll say they own it 50-50%. That home is in Alberta. It's not considered a secondary residence. It is their primary residence. Now, the home is not going to trigger too much taxation when the first spouse passes away, or even to pass it along to their heirs. But it is part of valuing what the estate will be under the estate administration and perhaps legal and accounting fees. So that's why it's so important to put in the principal residence on the home. Next,
So it would form part of the fee, Lori, in regards to like the administration costs, so the executor fees that might come into play, that 5% that you indicated earlier. You're going to have to include the principal residence as your total assets, and that 5% comes in there. Because I know in Alberta, everybody, it's a principal residence. We don't have to pay tax on the growth we received there. And you'll probably touch on this too, but probate fees are low here in our province also. So they go, okay, well, that's easy. There's no cost associated with liquidating my principal residence. But that's a good point that it can, it'll add to that administration cost because it forms a part of the total estate.
Absolutely. And home values, particularly in Alberta, are growing, right? That real estate rate is growing over time. And so that is an asset that will grow to a much larger value that, again, yes, there will be estate administration fees on that. So that's why it's important to put it into the calculator to get a more accurate picture of what those expenses are going to be when.
I got another, just sorry to interrupt you, Lori, another comment around those estate administration fees, executor fees, I guess, that you're speaking to. Do you ever have clients, balk at that fee saying, well, I've listed my son and he's not going to charge an executor fee, he's just going to do it, and so I don't even really want to include that. Do you run into that, or?
Certainly. However, things need to be in writing, right? While they may think that our family may not charge an executor fee, they are entitled to charge an executor fee. And there's a lot of work that goes, that's involved in being an executor. And so absolutely, each case can be a little different, but I would say get it in writing. If that fee is to be zero, get it in writing. But at the end of the day, that may not be fair to the executor, given the size and scope and complexity of the estate. Executors can take anywhere upwards of 5% of the estate value.
Okay.
Yeah. Most of the lawyers we deal with recommend to the executor to take that fee, especially if it's written in the will that's available for them to take because of that. And it's always interesting when you see how somebody's will flows and they've chosen their executor. Usually a child is how it mostly goes, and then they charge that fee, and then the rest of the kids go, well, I would have done it for free. So it's always interesting to, after the fact, the other kids are like, because they have no idea how hard it was to manage that. And secondly, I'm pretty sure the parents picked the child to be the executor for a reason. And that's just, there's a cost there. So these things are all shocking to the heirs at some point in the future. There's no doubt about it.
Absolutely. And it's best to work with the legal team, get things in writing so that there's no dispute later on.
Exactly. Yep.
Good. Okay. So fair market value. I'm going to use a fair market value of the home of $1 million. Okay. The adjusted cost base. So that's what was used. That's the purchase price of the home plus any large lump sums that were used to do renovations in the home to increase the value of the home. So let's say that it did cost $750,000 with an assumed growth rate of 3%. Okay. And of course, that's dependent on real estate. 3%, fairly conservative. In Alberta right now, on average, it can be 5% or more in the home value growing year over year. If there's still a mortgage on the home, Tyler and Dave can toggle the switch and add in the mortgage details on there. I just want to keep it more simplistic for today. And so I'll just assume that the home is paid for. Once we have the principal residence in, okay, we're going to add the second asset. Now, the one that I like to use, particularly to show how very fortunate we are in Alberta that we have very low probate fees, is when clients have a cottage. And let's say that cottage is in British Columbia. British Columbia is a province that has very high probate fees. And when it comes to estate administration, the probate is dependent on where that asset is. The probate fee may apply. So they may be residents of Alberta, but if they do have an asset in British Columbia, that particular asset would have to pay BC probate rates. So we'll say that clients have a cottage in the Okanagan. They own it 50-50. Okay. I'm going to change the province here to British Columbia. Okay. It is considered a secondary residence. Okay. It will roll tax-free to the spouse upon death of the first spouse, but it will not roll beyond the couple to their heirs tax-free. This is where there will be some capital gains, okay, on the increased value of the cottage. So we'll put in the fair market value today. We will say it's $600,000. The adjusted cost base, we'll say that they purchased it several years ago for $350,000, and it as well is growing at a 3% rate of return. If there's a mortgage on that cottage, Tyler and Dave can put in the mortgage details as well. Okay. And then we'll click save. Okay. Now, the next asset, particularly working with your investment advisors, you are going to grow assets in multiple investments. The one we see, or the one Tyler and Dave would see more often, is putting assets into the RRSP. So I'll hit the plus sign on that to add in the RSP. We will have to enter them individually, right? Because RSPs aren't jointly owned. They are individually owned. And so we'll say this is John's RSP. Okay, he is in Alberta. Fair market value. So just thinking of some typical RRSPs for age 50, we'll say there's $300,000 in the RRSP today, growing at a 5% rate of return. RRSPs, Tyler and Dave, if you want to jump in, but RRSPs will roll tax-free to the surviving spouse, just generally won't roll beyond the spouse to the heirs tax-free. That's when tax will be triggered from that RRSP.
I think a comment on that, Lori, too, is something that a lot of people aren't aware of. When you're naming beneficiaries on your RSPs, it doesn't form part of your estate. It gets paid directly to the beneficiaries, but your estate ends up with the T4 for that, which if your will is not written properly can cause a lot of problems if you don't have insurance funds. If you've decided that you're leaving specific assets to specific beneficiaries, you could end up leaving the tax bill to certain beneficiaries and not the others. So it's fraught with disaster potentially.
Absolutely. Great comment, Dave. Okay, so annual deposit, right? Many of you are doing your annual deposits. So for here, I'll say John is contributing $12,000 every year at a 5% rate of return. John plans to do that from year 1, and he plans to do it up to age 65. So we'll say 15 years from now. With RRSPs, they do have to be rolled into a RIF before the end of the year in which a client turns age 71. So you get that tax deduction when you're making the contribution, but eventually the government wants to get some of that money back. And so there are rules around the maximum age that it can remain in the RSP and then has to be rolled into the investment vehicle where there will be payments made to the client, payments that they may use in retirement. So for simplistic sake, I'm going to delay this as much as possible. I'm going to say they want to keep the RSP till age 71. They've got other assets to live on. They don't need to take those large lump sums from their RRSP. Okay? But of course, every client situation is going to be different. That is going to be a discussion with Tyler and Dave as to what the objectives are, okay? And when the income is needed. So I'll click save there on that. Okay, and then I'm going to do it again because Mary also has her RRSP. So say Mary. Okay, fair market value. Mary has 250,000. Rate of return on her investments is 5%. Hers too would roll to John tax-free. It just doesn't roll beyond John tax-free to the heirs. She's going to deposit now, and I'll just say 15 years. And Mary as well is going to roll her RSP into the RIF and take the minimum payment, okay, at age 71. So again, we're just entering the usual assets that many of our clients will have. Next, I'd like to show you rental property. We know many of you own rental properties, which is great, and it's growing in value. But of course, the taxation, right, is different upon death. Capital gains will be triggered upon death. So we'll say rental property, it's owned 50-50. Okay, it's in the province of Alberta. It will roll to the spouse and not trigger tax. It's just when both spouses pass away, that is when the capital gains will be triggered. So on the rental property, let's say it's a condo that they purchased several years ago and it's worth fair market value of $550,000. They paid $300,000 and it's earning average 3% or growing in average 3%. I'll click save on that asset. Okay. There are other investment options that clients may have, the TFSA, the non-registered portfolio. So we'll go ahead and enter that one, and then we will take a look at the report to see how much the estate has grown long-term to the age of 86. And then, of course, talk about the expenses on that estate. So we'll say non-registered, it's 50-50. Total portfolio value, is 300,000. Okay. It may roll to the spouse tax-free at death. It all depends on what it's invested in. And then, of course, matching the investments with the rates of return. Now, in this one, the equity, how much money was put into that plan. So I will use 150. Okay. And then, of course, matching the dividend portion and what the turnover rate would be. If the client...
Sorry, Lori, just on the TFSA, I guess that's another one to point out. Like, it's tax free to take it out. You're not paying taxes on the growth you've achieved there, but again, it would form part of the full estate and be exposed to that administrative fee of up to 5%.
Absolutely. Also, tax from the date of death. Anything that it earns from the date of death until that asset is transferred to another individual, that is taxable as well, that in between period. So it can for sure be added into the estate value and any tax that might be due. Okay. And again, if there's any large lump sum withdrawals, Tyler and Dave could add that into the calculator as well. Okay. Once we have the assets in, so very important to note that this is a personal estate needs calculator. It's not going to factor in at this point if the client owns a corporation, and it is looking at Canadian assets as well. Once we have that in, we can produce the sales report. And that sales report, while there are 8 or 9 pages, there's one page that a client will want to focus, and that is right here. What is the estate value going to look like at age 86? So these clients are saving hard, right? They're buying rental properties. They are creating a great future for themselves that are in a very healthy retirement plan. They've got these assets, though, that will grow to about 8.7 million by the time they reach age 86. Dependent on the assets that they're invested in. So remember, the RRSPs eventually will be taxable. That rental property is going to trigger taxable gains upon death. Any unrealized gains from that non-registered account, the taxes that will be due that the estate will have to pay before assets are distributed to their heirs. CRA is going to collect a little over $1.3 million of tax. And the estate administration and the legal fees, right? That 5% and the legal fees on that is about $466,000. Probate. Again, if all our assets were in Alberta, probate really not an issue, right? It's a fixed fee of $525 per person. But remember, our clients really like to spend their summers in the Okanagan. They own a cottage in BC. Upon death of the second spouse, that will trigger BC probate rates on the value of that cottage, okay, before that can be distributed to their heirs. So the probate...
Question there, Lori.
Sure.
Is probate payable on a principal residence?
No. Well, it's under if the principal residence is in Alberta, there is just a fixed fee for Alberta. If the client had a principal residence in BC, yes, that forms the value of the estate, and probate would be required on that.
It doesn't matter whether it's a principal residence, vacation property, or a rental property. It's the location. Probate is payable on it on the death of the second spouse.
Yes. Yeah. And each
As long
province...
as it's in joint, sorry, yeah.
Yeah. Each province has their own probate rate, and I will show you that because it will calculate the probate based on the assets that we put into our calculator in the province where that asset is. And of course, final expenses. We put that in inflation at 2%, right? So it's a little over 100,000. So the value of our estate is 8.7 million. But by the time the estate pays the expenses, pays the taxes, pays the administration legal fees, pays the probate, pays those final expenses, there's $6.8 million. That's what's left in the estate. There's roughly, just shy 1.9 million of expenses that the estate will be on the hook to pay. So it's not really maximizing the estate. There are, other things that we could look at to maximize the estate so that the estate doesn't have to sell its assets if it doesn't want to, that it can distribute that full value and have a lump sum available like life insurance to cover the estate expenses. Okay. or could be charitable giving and getting a tax slip, right, to cover off the expenses.
These estate expenses, Lori, I'm assuming due immediately upon filing the final estate tax bill.
Yes, yes.
People aren't going to be able to pay this unless they have very liquid assets. I mean, things like your rental properties, your second cottage or your second home, even the principal residence, that stuff doesn't move overnight, allowing you to free up the cash to pay some of these fees. Maybe the investment portfolios are liquid enough to access this kind of money quickly, but what happens if you don't pay immediately the estate tax bill? Are you running into a situation with CRA where there's fees and interest being charged?
Yes. Yes.
And that would add up
Absolutely.
pretty fast on a $2 million bill.
Yes, yeah. And general rule of thumb is the final estate administration has to be done within 6 months of year end. So at the end of the tax year as well. So they do have to be paid fairly quickly. Some clients may be okay with saying, well, I've still got some in my RSP or my RIF that will pay, right? The expenses if there's enough in there. But they've saved hard. They want to save as much of what they've saved and pass that on, right, to the next generation. And so things like the cottage, if there isn't enough in the estate, liquid assets in the estate, the heirs, the family may have to sell the cottage. What if they don't? They want to keep it in the family, right? We need to have something liquid enough to cover those assets so that the heirs, the beneficiaries, aren't forced to make tough decisions about what to sell or what to liquidate because mom and dad already had it, right? Looked after. So again, every client situation can be a little different. Most of our clients want to maximize what they're leaving behind and not give it to CRA. They want to have a lump sum there to cover those bills, or they'd rather leave their money to charity rather than, CRAs. So life insurance can be that cost-effective solution. Now, the report does go into, well, what are some of the solutions? Do you want to liquidate your assets? What are the value of those assets? If the real estate market is down, right? You don't want to die in a down year. It does talk about what some of the disadvantages would be in liquidating assets, or it could be borrowing funds if that's how they want to pay the estate expenses. But generally, the most cost-effective way can be life insurance, providing that lump sum benefit to make sure that those estate expenses are going to be paid in the future so that what they're leaving behind, right, all their sacrifices that they made, the majority of it will be passed on to their heirs or even to their favorite charity. Now, in this report, it does go into the assets, each of the assets, but what I'd like to show you now are the probate fees based on province. So in Alberta, it's a flat $525 per person, right? It's just a fixed fee. It's not valued on the estate value, which was a little over 8 million in our example. In British Columbia, there's a fixed fee of $200 plus $14 per thousand of value of that particular asset. And so, Dave, you made a great comment. If the client does live in BC, all those assets that we pulled into the report, principal residence, cottage, investment property, the RRSPs for each of them, the non-registered, they are going to pay the $14 per thousand, right? $14 per thousand of that 8 million. It will be a massive probate bill. Alberta, we're a little bit more fortunate.
Yeah, it's a lot of money.
Absolutely. The highest in the country is Nova Scotia. Okay, so if any of your clients do have property or assets in Nova Scotia, $16.95 per thousand and $1,000 fixed fee. A lot of our clients do have property in Saskatchewan as well, right? $7 per thousand on top of their probate fees. So this report, again, simplified version, easy to use, but really is that eye opener for clients who are thinking about the assets today, and they know the tax that they're paying today, but they're not looking 36 years out in my example to fully understand what their estate value is going to be and what those expenses are going to be. It's definitely worth the conversation around estate planning. How do we want to tackle what these estate expenses are going to be? What's the most cost-effective way? What are your wishes? Do you want to maximize, or do you want to leave some of that to charity? And that certainly can open the discussion around charitable giving.
Yeah, I think a lot of clients that you talk to assume that by the time they hit 86 or 87 years old, their hope is that they're rolling into the grave with little to no assets left. But I mean, that might be true of maybe their registered retirement accounts, their savings plans, but they're still, sitting on assets in their principal residence. Maybe they've liquidated homes along the way, their cottage or their rental properties. But a lot of these assets are, I wouldn't say trapped, but you're going to have assets when you pass away, unless you are, living on the street when you're passing away. But it's funny to think that a lot of people think they're going to wind things down to almost zero and they're not going to have to worry about the tax bill, and there won't be anything, to worry about here. It's very easy to see in your example here that these assets grow significantly over that long period of time, and they're going to have a tax situation when they get there.
Absolutely. Absolutely. Now, of course, it can move into the discussion around charitable giving, how to trigger a tax slip to the estate to, give a portion to charity rather than giving their money to CRA, right, to taxes. So I do have an example to show. If you can just bear with me while I change screens.
Sure.
Excellent. Okay. Now, important to note, and sorry, I should have mentioned this as I was talking about the expense needs. The expenses generally showed a little over 1.9 million in estate expenses at age 86. It doesn't mean that the client needs 1.9 million of life insurance today. Okay. Remember, they need that to cover the estate expenses at age 86 in the example that we used. So this is where having a discussion with your financial advisor, Tyler and Dave, as to what death benefit, what life insurance policy would we need today? At what amount would we need to purchase today that will grow over time to be as close to the 1.9 million at life expectancy. And so taking a look at the numbers for John and Mary, ideally, if we started with a $250,000 death benefit into a life insurance vehicle that grows over time, so participating whole life, where there's a dividend component that's growing that value of the death benefit. Each year that a dividend is declared, there is a higher death benefit. In this particular example for John and Mary, $250,000 today, purchasing on a joint last to die basis. So we don't need to purchase it individually. We're doing this to cover the estate expenses when both John and Mary pass away. The death benefit that would work for John and Mary is $250,000. Now the premium for the $250,000 with the additional deposit option over a 20-year period, because John and Mary want to pay it up on a guaranteed basis. So I did select a guaranteed 20-pay solution. In the event that John and Mary want to maximize their estate, to have that 1.9 million covered in expenses, but to also make sure that they're getting a tax slip for their estate, for the final estate return, to have a deduction, to limit as much as possible that's going to be owed to CRA right on that final tax return. Charitable giving can be a great solution, that they get this insurance in force today while they're young, while they're healthy on a guaranteed paid up basis into a vehicle that's going to grow long term. Then, of course, just taking a look, in the event John and Mary, both pass away at around age 86, in this particular structure, they would determine who is their favorite charity. And they could work with the charity. There's two ways to set this up. Work with the charity today to have the charity listed as the owner and the beneficiary of that life insurance program. The individuals, John and Mary, are the payers of that premium. And so if they do set it up with the charity as the owner and the beneficiary, for the annual premium that's paid, the charity can issue an annual tax slip that John and Mary can claim throughout their lifetime. That's one way to do it. But if it is more about covering the estate expenses, particularly the taxes that are going to be owed, there is another way to set up a charitable giving program that John and Mary can be the owners and the payers of the premium on that guaranteed basis, but they could list the charity as the beneficiary of their life insurance program. When John and Mary both pass away, in my particular example, they started with a $250,000 death benefit. They grew that death benefit using participating whole life and dividends long term. At age 86, when both John and Mary pass away, that death benefit has grown to $1.9 million to cover those estate expenses that we just uncovered using the estate needs calculator. In this scenario, if they did donate the entire death benefit to their favorite charity or charities, maybe they have more than one favorite charity, the charities will issue a tax slip that can be used on the final tax return of the death benefit. So the $1.9 million to help offset what could be owed to CRA. And so both Tyler and Dave do have access to a concept piece provided by Desjardins that will even take a look year by year at what that tax credit would be. This particular concept piece will look at getting the tax deduction each year as they make the premium payment. But of course, keeping in mind if the end goal is to cover the estate expenses, they can list the beneficiary and get a tax slip rather than on an annual basis, but when they both pass away for the death benefit that is paid to a charity in the future. And that's
for you,
one
Lori.
way to maximize their estate.
One question for you, Lori.
Sure.
When you built this, it shows a 20-year premium payment. Beyond 20 years, the policy still requires that premium, but it's now being covered by dividends and cash values in the policy. Are they still, if they were choosing to deduct their annual premium, would they be able to continue to deduct even though they're not physically depositing any more money into the policy? Are they still getting a deduction in the years beyond 20 because cash value is being used in the policy to pay the premium?
Yeah. So in my particular example, I used a true guaranteed paid up 20 years. So no further premiums are due, or we're not using the cash value to pay the premiums. So if they were to do a longer term, pay to 100 type of plan and then offset the premium, let the cash pay that, that could be a scenario where they could continue to deduct. In my example, I used a true 20 pay solutions. Okay. So they can deduct those premiums for as long as they're making those premiums.
Okay. And so they'd get those deductions. And then I'm assuming when the death benefit pays out, the 1.9 million, you would have already received a deduction for the, looks like about 280,000 that was deposited over the first 20 years. So that portion, you're not deducting a full 1.9 million, or the estate isn't on the full death benefit. They're getting, 1.7 or 1.65 or so after you take into account the initial deductions that they used for the 20 years they were making premium deposits. Is that right?
Yes. Yeah. So that's how our concept piece will show it. So they're clients who want the tax deduction today for one reason or another. That's how the concept piece shows it. But alternatively, if it's more about covering the tax bill at life expectancy when they both pass away. They're not going to deduct what they pay in premium over that 20 years, but what they will deduct is that death benefit that is paid out in the future. So the 1.9 million, that would be a charitable tax receipt that they could put on the final tax return to minimize the tax that's owing by an estate. So there's two ways to do it. And this is where clients will have a discussion with yourselves, right? Tyler and Dave. What's the most cost-effective solution? Are we looking for the tax deduction today, or are we going to look for the tax deduction for our estate once we both pass away?
Right. What happens if the client, the owner is then charity, and the beneficiary is the charity, and the client is making the payments for it, but they stop making the payments, and the charity starts paying for it, and then they pass away? Who gets the charitable contribution receipt?
You know what? That is a good question. If they are going to set this up, really, they should commit, right, to paying the 20 years. There are options in participating whole life, because every year that dividend declared, that's a guaranteed value. If they decided we can no longer pay the premium, generally the charity is not going to continue the premium, but they can change the participating whole life based on the value that's in the contract at the day they say we can no longer pay the premium. There are a reduced paid up option. So a lower, potentially lower death benefit, but no further premiums would be due. So we would have to
No receipt. Yeah, there might be a receipt, there might not be a receipt.
Okay, well, that was good, Lori. It is, as you said, eye-opening to see. I wouldn't consider the clients that we reviewed here to have modest savings, but relatively, average or maybe above average in terms of where they are in their life. But very common, I guess, to see those types of numbers for people in their late 40s, early 50s. So to see that estate grow, even considering the redemptions that you're taking from your retirement accounts, to grow to that $8.5 million range with very conservative numbers. I mean, we're conservative here at a 5% growth rate on investments and a 3% on our properties. If you do any better than that, these numbers are going to get even bigger, even faster. So, that's tremendous, the costs that people will run into. So, what clients should be concerned about is, how does my estate liquidate things in order to cover these tax bills? What do they sell first? What are they going to have access to money-wise to pay this $2 million estate bill that I'm going to run into? So that should get them thinking as to, what do I need to sell? If I want to pass that cottage on, how do I do that?
Well, even in this, the example that you ran, they don't have the liquidity. You would think somebody with $8 and change would have the liquidity to pay, but they don't. They're typically 99% of our clients that have a will also would have beneficiaries on their RSPs and RIFs. And that's not a liquidable asset unless it obviously gets paid to theirs, but you now have to collect that money from theirs to pay the tax bill. That could be a problem. I think they had maybe $1.3 million in non-registered investments, and with a total wrap-up cost of 1.9, you're still short $600 and something thousand if you can't touch the RSPs or the RIFs. So, anybody who would be told that is your net worth at passing at age 86 would not be worried about having to pay the tax bill on it. They would say, my state's got it, my kids have it. And in this case, it's not even there. Yeah. So it will cause some scrambling. It will cause some friction between the beneficiaries who don't want to give anything back to pay for a tax bill, and it'll probably force a potential fire sale of the cabin or cottage in the Okanagan and possibly the rental property scenario.
Yeah, and there's closing costs and administration fees and legal and professional dues charged to liquidate those positions.
Well, and time. I mean, if you pass away in the first 6 months of a year, you don't get to wait till the end of the year to pay your tax bill. CRA wants your final estate bill quite quick. Yeah, so you think about figuring all of this out. You're how many months in when you realize what your tax bill might be, and then it's like, well, it's due on this day. How do you sell a hunk of real estate in that quick period without cutting the price?
Yeah. And if you got a $2 million tax bill, what's the interest and penalties on that every month?
What happens when you don't pay it? CRA comes and seizes one of those properties and then just sells it for whatever they can sell it for to pay your tax bill. And it's probably lower than the fire sale price you're going to sell it at.
Yeah.
Could be. And so prudent financial planning, taking a look today, it's working with Tyler and Dave. Let's make sure there's not any surprises, that clients know what the potential tax bill could be and look for an effective solution, right? That could cover that.
You bet.
Yeah, I think you've summed it up nicely. We have lots of clients and they do think about these kind of things, but in reality, they do what the comment was earlier. You know what? There's enough money. I'm not worried about it. And you know what? Whatever problem there is, my kids can work out. I've left them something. I'm sure there'll be enough to take care of all of this. And when you do the math on how that might unfold, you're talking hundreds of thousands of dollars in difference of what would have been the state to what it's going to end up being if you don't address it ahead of time.
Two things in life are certain, right? Death and taxes. So.
Yeah, for sure.
And kids fighting.
Well, that was good, Lori. I'm glad that we got our cameras working this time and we could see you live on screen today. So we want to thank you again for joining us here on Smokin Bulls. We hope to have you back again. There's all sorts of unique insurance strategies out there, so I'm sure we'll have you as a guest again in the future, and hopefully you'll be willing to join us now that we got things working on our end.